If you don't understand how your money is structured, you're taking on risk you don't even see. Today, we're breaking down the role each piece plays, from the assets in your portfolio to how money moves through the economy to how your retirement plan should be structured over time. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Diamond Point Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors interpret the system and build strategies designed to move with it. This week, we're continuing that process by connecting the dots. First, we'll go deeper into the market, breaking down how different asset types function and why each one plays a specific role inside a portfolio. Second, we'll look at the economy, focusing on how the Federal Reserve uses tools like quantitative easing and tightening to influence liquidity and overall economic activity. And third, we'll bring it back to your plan, walking through how to fund your retirement accounts and why each account type serves a different purpose over time. Understanding how each role works together allows you to stop guessing and start building with structure. While stocks have recovered from some of the fluctuations we've seen recently, we should continue to expect volatility this year, not just because of ongoing conflict in the Middle East, but also because this is a midterm election year. Valuations have been stretched in certain areas, and there's still a fair amount of uncertainty in the market. As we discussed last week, one of the ways we try to manage those shifts is through diversification and asset allocation. This week, we're going to review how those assets function inside a portfolio. Too many people think of risk as simple categories, low, medium, high, but that's not really how it works. Risk is a spectrum, and you can structure a portfolio to align very specifically with where you're comfortable. Even beyond that, it's less about what you own and more about the role each piece is playing. At a high level, most investments fall into a few functional categories: capital preservation, income, growth and aggressive growth. Each one behaves differently, and more importantly, each one serves a distinct role within the portfolio. What we're seeing in the market right now is a perfect example of how different parts of the market are responding differently to the same environment. One of the simplest ways to think about this is like a seesaw. On one end, you have fixed assets, things like cash, money markets, and short-term bonds. Their role is stability, liquidity, and capital preservation. And in periods of uncertainty, we've seen these areas become more attractive for certain investors. On the opposite end, you have aggressive growth assets, small cap stocks, emerging markets, and certain alternative investments. Their role is to pursue higher long-term returns, but they also come with higher volatility and more significant drawdowns, especially in an environment where rates are elevated or expectations begin to shift. Then, right in the middle of that seesaw is where you find growth and income assets. This includes large cap stocks, companies with consistent earnings, and often dividend-paying investments. In more uncertain environments like the one we're in now, this category has tended to behave more consistently compared to some of the other more volatile areas of the market. Just like a seesaw, the center tends to be the most stable part. That's why this category often plays a foundational role within the portfolio. Over the years, I've seen too many investors and even some advisors continue to build portfolios starting at the ends and then try to balance inward. The challenge with that approach is that it can introduce more fluctuation than necessary because you're constantly trying to offset extremes. Instead, I prefer to start in the middle, building the foundation with growth and income. It's where you have participation in the market, some level of stability, and more consistent behavior over time. Then from there, I expand outward. Once the foundation has a clear role, everything else can be layered more intentionally. Rather than reacting to volatility, the goal is to structure the portfolio to account for it in advance. Each layer has a purpose and each asset has a role. Fixed provides stability. Income provides consistency. Growth provides long-term appreciation, and aggressive growth can provide opportunity. When these roles are clearly defined, especially in environments like this, you can have a clearer expectation of how each part of your portfolio may respond. Quality also becomes an important part of this process. I prefer to focus on highly rated investments and long-term data so I can evaluate how those assets have behaved across different environments. That allows me to communicate more realistic expectations with my clients. Now, it doesn't guarantee a higher outcome, but it can help reduce unnecessary risk. And as I mentioned last week, my clients and I value consistency. We are not chasing home runs. We're focused on steady, repeatable results. But that doesn't mean every portfolio should look the same. The way we build your structure depends on your time horizon, your risk, and what that money is meant to do in your life. So each portfolio may look different, but the core principles stay the same. The goal is to have a well-diversified portfolio built with high-quality investments based on your specific plan. Last week, we talked about what money is and how it moves through the system, particularly through banks and lending. This week, we're going to take that one step further and talk about how the system itself is managed. Just like investments have a role inside a portfolio, institutions also have a role inside the economy. As we've discussed, at the center of that system is the Federal Reserve. One of its primary responsibilities is to manage economic stability by influencing liquidity, lending conditions, and overall financial activity. One of the ways it does that is through quantitative easing and quantitative tightening. Quantitative easing, or QE, is when the Federal Reserve injects liquidity into the system. They do this by purchasing assets from financial institutions, primarily government bonds and mortgage-backed securities. When that happens, it increases the amount of money that's circulating in the system. It typically lowers interest rates, encourages lending, and can support economic growth. We saw this very clearly in 2020 and 2022. In response to the COVID-19 pandemic, the Fed launched significant QE, expanding its balance sheet from roughly $4 trillion to about $9 trillion over 2 years in an effort to keep credit flowing. That increase in liquidity supported markets, lending, and overall economic activity during a very uncertain time. On the other side of that is quantitative tightening, or QT. This is when the Federal Reserve reduces liquidity in the system, typically by allowing those same assets to roll off their balance sheet or by selling them. Now, when we say roll off, we simply mean the assets matured and they were not reinvested. When that happens, the money used is effectively removed from circulation. Interest rates may remain elevated, lending conditions can tighten, and financial activity can slow. And that's more in line with the environment we've been in recently. As inflation increased, the Federal Reserve shifted its focus from supporting growth to slowing the pace of the economy. Just like we've talked about in the market section, different parts of the system respond differently depending on the environment. When liquidity is high, risk assets tend to perform better. When liquidity is reduced, volatility can increase and capital often becomes more selective. Nothing exists in isolation, especially when it comes to the economy. Banks create money through lending, the Federal Reserve influences how much lending happens, and together those forces shape the pace of the economy. This month, we started the conversation around retirement. First, we focused on the vision, and then we walked through different types of accounts and tax exposure. This week, we're going to take the next step and talk about how and when to fund those accounts. Now, we're still working with the same 3 categories: traditional accounts, Roth accounts, and non-qualified or taxable accounts. Each one has a different tax treatment, and each one serves a different role in your long-term plan. So when it comes to funding these accounts, there are a few general principles to consider. If you have access to an employer-sponsored plan with a match, that's typically one of the first places to start. From there, many investors look to continue building into a tax-advantaged account like IRAs or 401ks, depending on eligibility and income levels. And then beyond that, non-qualified accounts can provide additional flexibility since they don't come with the same contribution limits or withdrawal restrictions. Now, every day on social media, I see people giving blanket advice. Get this match, and then max out over here, and then fill this bucket, and then go back to this. And that's a lot to keep up with. And oddly enough, it simplifies strategy while making the process unnecessarily complicated. The key here is not order, it's the purpose. Traditional accounts may play a role in deferring taxes today. Roth accounts may play a role in creating tax-free income later. And taxable accounts may provide flexibility for access, timing, and planning opportunities. So while the goal may be to build across all 3 over time, it doesn't have to happen all at once. At a minimum, many individuals consider contributing to both qualified and non-qualified accounts, but how that is structured can vary depending on your situation. I do tend to agree that getting the match from your employer is often the first step, but that doesn't necessarily mean you should immediately shift to an IRA or max it out. In fact, for some individuals, there may be little or no benefit in doing that. Individual retirement accounts, or IRAs, can have different restrictions and tax deductibility depending on your income. For example, higher income earners may not receive a tax deduction for traditional IRA contributions, and they may also be ineligible to contribute directly to a Roth due to income limits. However, their employer-sponsored plan may still offer those tax advantages in the current year, and some plans now include Roth contribution options without the income restrictions, depending on the design of the plan. And it's important to keep in mind, consistency is key. If contributing through your employer plan is the most practical approach, that can be an effective way to build over time. Some households may also consider strategies such as Roth conversions or backdoor Roth contributions. A Roth conversion generally involves moving funds from a traditional IRA into a Roth IRA, which may create a taxable event in the year of the conversion. And in some situations, this strategy can be beneficial, but it should always be evaluated carefully based on your full financial situation. What's most important is that you have a structure and a plan. You might currently be maximizing contributions to a traditional 401k while also contributing to a taxable account. But within your plan, you can identify future opportunities where a Roth conversion could be considered, such as a lower income year or during a market correction. At a minimum, some individuals may evaluate Roth conversion strategies in the early years of retirement when income may be temporarily lower. So while you may not be doing everything all at once, you are still planning for how each piece will be addressed over time. That gives you options, and as we discussed, in retirement, options matter. Every part of your financial life has a role, and when those roles are clearly defined, your plan becomes more intentional, more flexible, and easier to adapt over time. Today we looked at how different asset classes function, and we broke down how money moves through the system, shaping liquidity and economic activity. And we continued building your retirement plan, focusing on how to fund your accounts and create flexibility over time. Every part of your financial life has a role. Understanding how each piece fits into the larger system allows you to build a structure that can move together and with the cycles rather than against them. Next week, we're shifting the conversation to debt. We'll discuss how debt moves through the markets in different ways. On the economic side, we'll take a closer look at government spending and debt, and we'll close out April's strategic focus on retirement by discussing how debt can impact your long-term plan. If today's discussion helped bring clarity to what you're seeing in the markets and the economy, make sure you subscribe so you don't miss future episodes of Pointe Perspective, where we continue breaking down the process behind strategic financial planning. To subscribe to our weekly newsletter, or if you have questions about your own situation, you can always reach out using the contact information below. I hope this gave you some useful perspective. Until next week, take care.